There's a lot going on, as always, with investing. My first slide is actually taken from the Woolies website. So you've read in the news, I'm sure, about the coming food inflation and shortages. And this shows that even here, Woolies has had to ration sunflower oil, only one allowed per customer. By way of introduction, I've got 3 slides on different technology companies, and I've classified them. The first category I call bubble stocks, and Zoom Video is one of these. So Zoom, you can see it reached a peak market cap in 2020, and at that time the market cap was $160 billion, and that's a similar order of magnitude as South Africa's GDP. You could buy at the time 10 first-round banks with one Zoom. And since then, investors in Zoom have lost almost all their money, and the share's down more than 80%. And yet, it's still got a market cap of $30 billion and a valuation of about 7 times revenue. So it's not that the stock has fallen far and it's now obviously cheap. It may still be expensive. The second category of stocks is Chinese tech or Asia tech. And here I've chosen Pinduoduo as my representative stock. The share, similar picture, right? It was one of the fastest growing companies in the world for a long time. Investors made 10 times their money in a short period. And again, you've lost almost all your money in this share. Pinduoduo, I should explain, it's a social e-commerce company. It's kind of a mix between Facebook and Herbalife. What you do is you get together with a bunch of friends and sort of 20 of you order a crate of watermelons for a big discount straight from the farmer. And it was working very well for a long time. It has not worked so well recently. And the third category of technology stock is what I call big tech. And I've chosen Amazon here. The big tech players, you all know them, Apple, Facebook, Microsoft. They've had pretty different performances so far. They've all been weak, and this is going to be very interesting to see how this plays out over the next couple of years. They've all, despite falling, had a tremendous decade. They've grown amazingly well. They've touched all our lives, but the next decade could be very different. One thing, for example, which gives me pause for thought here is, well, guess where Zoom has been spending a lot of money over the last couple of years? Well, they've probably been spending a lot of money on Amazon Web Services and advertising on Facebook and Google. And these tailwinds could now change into headwinds. So it's obviously the bubble stocks are related to the big stocks in this way. This is a summary. On the left there, I've got 4 examples of what I call bubble stocks: Peloton, Beyond Meat, Zoom, and Delivery Hero. You can see all of them down more than 80%. In the middle there, I've got Asia Tech, and Tencent and Naspers are in that group. Right? Tencent has been the best of a bad bunch, but it's also fallen a lot from its highs. And then US tech, you can see what a mixed bag it is. Netflix, you've lost 75% of your money from the peak, but Apple hasn't been nearly as badly hit. All right, and then just one more foreign slide, because this is not the Orbis presentation, it's the local investment update, before I head on to local slides. This is the return you've had from investing in the US 30-year bond. So it's the 1-year return for lending money to the US government. Now, let's say a year ago, you decided you don't want to stomach any more volatility, you want to lock in something safe, and you want to lend money to the best credit risk in the world, the US government, supposedly. Well, if you want to get out of that trade now, you're going to get back 30% fewer dollars than you put in. And why has this happened? It's because interest rates have gone up. And that's a problem when you fixed in a low rate for a very long time period. And this slide kind of illustrates that there's really no sure thing in investing. And you can always overpay for an asset. In the fixed interest world, overpaying for an asset is lending out money at too low an interest rate. All right. This is the largest drawdown that investors in the Aussie have seen over the previous 5-year period at various points in time. So the way to read this chart is look at, for example, 2008 there. You can see that, boom, the Aussie fell 50%. And for the next 5 years, that was the largest drawdown that investors had seen. And then things started recovering, and for quite a while, investors, there was no big drawdown within the preceding 5 years until COVID hit. And there's another big drawdown there, which you can see we're in that. That's the most recent drawdown. That's the biggest drawdown within the previous 5 years is obviously the COVID drawdown in the Aussie. And what I want to highlight with this chart is that the unusual thing is not the big COVID drawdown. The unusual thing here is what we had just before then, where we didn't have a huge drawdown within the previous 5 years. At almost every point, there's a 40 or 50% Aussie drawdown within the preceding 5 years. I found this very interesting. Sort of people imagine markets are more stable than what they are in reality. All right. Moving on now to something a bit more tangible, and I'm going to talk a little bit about local economics and especially what's been happening to our currency. And the Rand has actually held up reasonably well over the last couple of years. So this shows the Rand versus the US dollar. And you can see that it's been pretty stable for a decade. And actually the US dollar has been the strongest currency in the world pretty much. Versus the euro and the pound, the Rand has been actually quite strong. And why has this happened? We all read the bad news every day. We all know South Africa has a lot of government debt, and we have problems with, so we have big unemployment. Why is the Rand holding up? Well, it's because currencies are kind of a reverse beauty contest, right? It's about who's the least ugly participant. And so you've got to compare, when you're looking at the Rand, you're always looking at, okay, versus the euro, versus the Rand, versus the dollar, versus the Japanese yen. And all those currencies are also looking quite shaky. And all those countries have their own problems. And I'll talk a little bit more about that in a moment. What's also helped us is South Africa is a commodity exporter, and the prices of the things we export have gone up a lot. So in 2019, we were exporting 20 billion rands worth of rhodium. And in 2021, we were exporting 160 billion rands worth of rhodium. That's not because we got a lot more efficient at mining. It's because the price of rhodium went up a lot. And the same can be said for many of our other big exports. It's been a huge tailwind. On the import front, we're an oil importer, but that hasn't offset the big price increases in the commodities we export. And you can see here our current account deficit, which these are the red bars, has now turned into a current account surplus. Basically, for the first time since 1994, we're running a substantial current account surplus. We're exporting more than we're importing. That's great for the currency. The other thing that is helping us is our inflation is relatively well controlled. This says SA versus US inflation. What I've actually done here is I've taken the rate of inflation in South Africa and I've subtracted the rate of inflation in the US. So when this line is negative, it means the US has a higher rate of inflation than SA. And our latest inflation rate is 6.5%, reported yesterday. The US inflation is running at 8.6%. It's higher than SA. UK and Europe are running at 9%. And what's happening here, I mean, the South African Reserve Bank actually has quite a good 20-year track record of fighting inflation and raising rates when necessary and administering the tough medicine to the economy. Whereas you can't say the same for the Fed, and much less so for the ECB. So William McChesney Martin, he used to say that the Fed's job is to remove the punch bowl just when the party starts going. And what did he mean by that? Just when the economy starts getting too hot and overheated and people start bidding up the prices of things, the Fed is supposed to raise interest rates, slow down the pace of economic activity, sometimes even induce a recession, and thereby lower inflation. And what's actually been happening in the US is instead of taking away the punch bowl, the Fed has been handing out the proverbial tequila. They've been sort of running a system of very, very easy money for a long time, even in the face of very rising inflation. And this is very worrying, I think, for the US going forward, and it makes SA look relatively good. Versus our emerging market peers, we also don't look so bad. So Russia was big in the EM index. It's fallen out, obviously. China and Taiwan are also big. There are also worries there about potential geopolitical events. Peru and Colombia have both elected very business unfriendly leaders in the last year. Turkey, as you'll see, has a very high inflation rate, lots of economic problems there as well. So all these peers also, things are not looking so great for some of them. and SA is comparatively stable and looking relatively more attractive than it was 5 years ago. This is the rate of inflation in a couple of countries. Our latest wasn't updated for our latest one, 6.5, but we're looking pretty good here, right? Much lower than India, Mexico, Chile, Brazil. There's Turkey, 73% inflation rate. Argentina has been very high for a long time. And in the long term, the higher your inflation rate, the worse for your currency. And you can see here relative to the dollar, SA has been outperforming some of its emerging market peers. Brazil's been doing actually very well. Its currency was really weak a year ago, and Brazil is a big beneficiary from higher world food prices. But SA not too bad against the dollar. All right. This is the rate at which investors are willing to lend money to the South African government. And it's gone up to close to 11% recently for the SA 10-year bond. And what is this saying? It's saying that investors are worried that either the SA government won't be able to repay them, or that their return will be eaten up by inflation, right? If you're lending out money at 11% and inflation turns out to be 11%, well, you're making a 0% return in real terms lending out that money. It could be that investors are too negative and that this is a very cheap asset right now and it's a very good deal. At least the rate at which you're lending out money to the SA government is a lot higher than the current inflation rate. Whereas in many developed countries, in most countries in the world, the rate at which you lend money to the government is a lot lower than the current inflation rate. This is the Aussie in dollars versus emerging markets. The Aussie's actually had a very strong performance versus other emerging markets, but this is the Aussie versus the MSCI World Index. And you all remember the great sort of decade we had, the noughties, where South African businesses were doing well, our retailers were growing revenue fantastically well, rolling out space. GDP was growing at a high rate, and boy, it's been a different past decade, more than a decade now. And that's reflected in our market having massively underperformed the world index. Here I've got the returns of a couple of large companies listed in our market. And I thought I would just spend a few minutes talking about what's been happening with these stocks over the last year. I've got a color code. The green is the banks, red is resources, and the dark gray, that's everything else, including insurers. And you can see here it's been a great year to be invested in banks, right? The banks have all done very well, all outperformed the market. Investec the best by a mile, and Nedbank also doing really well. And resources is very mixed, right? Sasol's had a great year, Glencore's had a great year in terms of total return to shareholders, right? That's share price plus dividends. Whereas the platinum group metals companies and the gold miners have had a much less spectacular year. They've underperformed the market. Goldfields, AngloGold, you can see there, AngloGold a negative return in the past year. RMI there is interesting. So RMI has given you a great return, 70% in 1 year. And what's happened at RMI? Well, RMI is an insurance holding company. And it was trading a year ago at a 40% discount to the sum of its underlying holdings. It owned stakes in Hastings and Momentum and Discovery. And you could add up the value of those stakes and you compare what RMI is trading at. And if the stakes were 100, RMI was trading at 60, right? So 40% discount. And the board said, well, our shareholders obviously don't like this. We're going to wrap up the structure totally. They unbundled Discovery and Momentum. They sold their stake in Hastings. And RMI now is only a vehicle for outsurance. It's basically a listed outsurance. And boy, has the market liked this. And why do I mention this even? Because, well, what's Naspers, right? Naspers is on the right-hand side there, the worst share over the last year. And Naspers is also a big holding company trading at a 65% discount to the value of its underlying holdings. And management there are also pretty keen to close this discount, pretty keen to do some corporate action to try and add value for shareholders and even take advantage of the discount. And there's a potential for value unlock there going forward. I'll maybe just mention Mondi as well. Mondi is the only really big SA stock that's had direct exposure to Russia. 17% of Mondi's profits came from a paper mill in Russia. And those profits are probably gone. But Mondi's share price has fallen by more than that. And actually what's also happened is Russia is a big exporter of paper to Europe. And those exports are no longer happening. And this has benefited all Mondi's mills that are located in mainland Europe. There's a big shortage of paper. The price of paper and packaging has shot up, and that's Mondi's earnings are higher than they were before they lost Russia. So this could be a potentially very interesting share for us, and we're looking at Mondi closely. The other thing that helps Mondi is all their mills are integrated. What do I mean by that? They generate their own energy, and many of the competitor mills have to buy in gas or energy, and this is as energy prices go up, that's a competitive advantage for Mondi. Now I'm going to show you the same picture here. I'm not going to change the order of the shares, but I'm going to show you the total returns over 5 years, not over 1 year. And you can see here, resources have been the shares to own over a 5-year period. Even though some of them haven't had a great year, despite that, they've still had a fantastic 5-year return. And you can also see, I guess, their Capitec, how much it's outperformed its banking peers. And these are annual numbers, right? So you've got from Anglo Platinum, you've got almost a 50% annual return over 5 years. Amazing returns from the PGM producers and from Anglo American. All right. I mentioned Russia, and we're looking at opportunities. I've spoken about Mondi. The PGM producers are potential beneficiaries from what's happening there, but I'm not too sure. Initially, the stocks went up a lot because Russia is the only other producer of PGMs. But I kind of suspect, because it's a very easy thing to transport, those Russian sort of ounces will find their way onto the market anyway. Right. Now, I should speak, I've mentioned Naspers quite a lot. This is the discount over time, right? So you can see here for a long time, Naspers was trading at a 40% discount to the value of its underlying holdings. What are the things that that Naspers owns? Well, the biggest one is a stake in Tencent, right? A Chinese technology company. And it also owns some stakes in listed food delivery companies. It has a big classifieds business. It's been making investments into education technology, and Naspers has for a long time traded at a 40% discount to the sum of its holdings. And if you'd asked me back then, I must say I wouldn't have thought the discount could even get as big as 60%. That seems like an outrageous discount for a company, unless you sort of sure the CEO is going to run the company into the ground. It's a big discount, and it's gotten to close to 70%. It hit 70% at one point. So a very big discount, and in our minds, a very big margin of safety if you own the stock now. This is a summary of the areas that Naspers is exposed to. The red is Tencent. Tencent is in games, social networks, advertising. It's got a cloud business. It's got its own big portfolio of listed stakes. And then I've mentioned the other things that Naspers is invested in. I won't talk too much more about Tencent. One of the stocks owned by Naspers is Delivery Hero. Now, this is now one of the non-Tencent investments. And initially, Naspers did a great job of buying Delivery Hero. They bought it pre-IPO, before it listed, and they got in at a great price. And for a long time, it looked like they made a fantastic return on the investment. But unfortunately, they kept increasing their stake, and they bought more of Delivery Hero right at the end of last year at kind of 130 euros a share, and Delivery Hero has fallen all the way to 35 euros a share. So as it happens, all in all, it hasn't been a good investment for Naspers. And when we're looking at the share, this is one of the decisions we have to analyze. And it's an interesting company because it's been growing really fast, right? This is gross merchandise value in euros. Delivery Hero is like Mr. D or Uber Eats, right? You order a home meal on your phone. And GMV is the total value going over the platform. So if you order a burger for $100, that will be $100 of GMV. Obviously, their revenue is going to be lower because some of it has to go to the restaurant. But you can see how popular the app has been and how fast they've been able to grow GMV. And we think, we're very happy to pay up a big multiple for a high growth company like this. But the next slide, Delivery Hero has made big losses, and the losses have been growing as their GMV has been growing. So what I'm showing here is EBITDA negative 4% of GMV. That's the red line, and no real evidence yet of any economies of scale or anything improving much as the company's growing. And to get to a positive operating margin, you've got to add back not only all the losses that Delivery Hero makes on marketing, or all the marketing spend that Delivery Hero does, but you've also got to add back all the losses they make on delivering food. And then you get a sort of a reasonable 4% of GMV operating margin. So this is like a classic very difficult company to analyze. High growth, you want to pay for that, but negative EBITDA, and the jury's out whether the company will be able to improve these economics. And that's what we spend a lot of our time trying to analyze and think about. These stocks have like you've seen, this is one of the bubble stocks. They've massively fallen out of favor. A year ago, the market could only see the fantastic growth, and now the market can only see the big losses. And I guess it's our job to try and take advantage of the market's irrationality. I've got here our top 10 shares. You've seen them already. We are quite happy with the valuations of these companies. A lot of the big overseas tech stocks, for example, those are a tough call. Those are companies that they've fallen a lot, but they're still trading on very big price to earnings ratios and even higher price to free cash flow ratios. And some of their accounting has been a bit optimistic. Whereas all the stocks on this list are trading at what we think are very attractive valuations, and we're happy to earn them. Now, recently we've been given an opportunity to take more of our funds offshore. Regulation 28 is the regulation which says how much of a balanced fund can be invested offshore. And that limit has changed from 30% to 45%, basically. You used to have another 10% that you could have in Africa, but it's basically gone from 30 to 45. Now, we haven't taken advantage of this yet. And you can see on this slide how actually we were lowering our offshore exposure in the balanced fund, and we were below what our allowance was before the regulation changed. And that's because of what I said earlier. We see really great prices available for local assets. And we kind of watching these prices, and we'll move money offshore when we think the prices justify it. This is the asset allocation of the funds. I've spoken about the foreign ex-Africa portion. That's the 28.4 in the balanced fund and 26 in the stable fund. And the balanced fund has a equity exposure of 70%. Those are kind of the important numbers here. I won't go into the sector allocation now. Just a little bit on performance. So the performance has been really good. We've had a great year. So on the left-hand side there, you can see the balanced fund has done 11+% over 1 year, and that's compared with a benchmark of 7.3. So 4.5% outperformance from the balanced fund. The stable fund has also outperformed its benchmark. The equity fund has matched its benchmark over 1 year. Even over 3 years, 5 years, and obviously since inception, balanced and stable have outperformed their benchmarks, not by as much as we would have hoped, but if we have another few more years like this year, those numbers will start looking a lot better. Equity fund has not outperformed its benchmark over 3 and 5 years. And a big reason for that, or one of the big reasons for that, is the foreign portion of the equity fund has actually not done as well as the foreign portion of the balanced fund. And yeah, again, those numbers are improving, and we're hoping it'll be a different story when we speak to you again next year. This is my last slide. So what this shows is the real returns in excess of inflation that you've had over the very long term from cash, bonds, and equity. Bonds is lending out money to the government. And you can see here, since 1900, you had a 9.1% return over and above inflation from investing in South African shares. And that's a really good return. It's one of the best in the world. And since from 2001 to 2010, I spoke about that great decade we had. Just you had a 14% real return investing in South African shares. And the more recent decade, from 2011 till 2020, you got a 4.8% return. Not nearly as good, not as good as the long term. And a lot of clients ask me, well, what's this decade going to be? And obviously it's a very difficult question to answer, and mainly because I have no idea. The only thing I will say here is that our starting point is a lot lower than it was in 2010. We think the valuations of stocks are more reasonable, and you've got a decent chance of getting at least positive real returns from equities and bonds over the next decade. So in conclusion, we will take advantage of the Reg 28 limits when we think prices justify it. Naspers, unfortunately, the share has lost some real value. We don't think it's going back in a hurry to its previous peak, but we do think from this point it offers very good value and a good margin of safety. And then finally, it's probably going to be quite a bumpy ride the next couple of years, but we think the valuation of the shares we own in the portfolio, the valuations are quite attractive.